Hey everyone, today I decided to add another $1,000 to Hercules Capital. I already had a position, and after going through their latest earnings call and the numbers that came with it, I felt more comfortable increasing the size. In this video, I'll focus on what stood out from the earnings, the specific reasons that led me to add, and then I'll briefly show how the position looks after the purchase. Let's get into it. The second quarter earnings call stood out for a few clear reasons. Hercules reported record total investment income of $149.1 million, up 8.5% from the same period last year. Net investment income also hit a record at $92.9 million, or 50 cents per share. That 50 cents covered the base dividend by 125%, which is a healthy cushion. For the first half of the year, total new debt and equity commitments reached a record $2.74 billion, up more than 35% year over year. Even with elevated early loan repayments in the quarter, they still managed strong fundings and kept credit quality in good shape. Non-accruals remained very low, and management highlighted that they still have significant spillover income of about $172 million. That spillover gives them flexibility if they want to maintain or supplement the dividend in future quarters. Overall, the tone on the call felt measured and confident. They weren't overpromising, but the numbers supported continued strength in originations and earnings power. A few specific points from the earnings push me to add. First, the dividend coverage felt comfortable. When a business development company can cover its base distribution by 125%, and still pay a supplemental, it lowers the risk of a cut if originations slow or repayments stay elevated for a while. Second, the originations platform continues to perform well. Even after a quarter with heavy early repayments, they still put up strong commitments and fundings. That tells me the pipeline remains active, and they're still finding opportunities that meet their underwriting standards. Third, the company closed a $325 million institutional notes offering in late July. That extra capital improves their liquidity and gives them more flexibility to fund new loans without relying as heavily on equity issuance. I already like the overall structure of the portfolio, mostly senior secured and floating rate loans to venture-backed and growth companies. Hearing management sound measured while the numbers showed real earnings power made me comfortable putting a little more capital to work at this level. Just to keep things transparent, here's a quick look at the position. Before the purchase, I held about 133 shares, with an average cost around $15. The position was already up modestly. With the $1,000 add, I picked up roughly 58 shares, bringing the total to around 191 shares. On the dividend side, the next payment should come in higher because of the additional shares. I'm estimating it will be close to $90 when it is paid in mid-August. These are simply the numbers so you can see the change in size and income. Nothing more than that. Overall, I feel good about the decision. The earnings showed solid coverage, continued deal activity, and a balance sheet that still has flexibility after the notes raise. I'm still watching the usual risks, including the premium to net asset value and the potential for lumpy repayments going forward. But at this position size, I'm comfortable. I'll check back in once the next dividend is paid and as future quarters come out. Thanks for watching, and I'll see you in the next one.